trillion, there is a fair chunk of that money being kicked around on that pairing. Yeah, I find it absolutely fascinating that you can put a line on a chart. You can draw a line on a chart because these aren't there. You draw that line. I find it absolutely fascinating that whatever percentage it is, let's say $500 billion, might be more, I don't know. But let's just say that it's $500 billion kicking around, it's going up and up and up and up, and then it actually stops bang on the line. I just find that remarkable. But it happens time and time again, doesn't it? Yes. Yes, Kevin. Yes, Kevin. Right. Likewise, when you get to support, now you've heard the expression, give the market room to breathe. Yes? Right. Giving the market room to breathe means that when the market has stopped there and gone up and is now heading back down again, you do not assume that it's going to touch the line exactly. You assume that the smart Alecs out there in the big market are going to get very close to it and then turn the market around again. So giving the market room to breathe is, and it's this greed factor, you are looking for 500 pips. Be happy with 450 rather than 500. If it goes to 500, fine. But if it gets close to 450, protect the trade, which we'll talk about later on. So that's giving the market room to breathe, because it stopped there, and when the market went up and came back again, it stopped very much in line with that. And it does this on a continual basis. Now, as it happens, this particular line was what we call a psychological support line. The markets love zeros, and anything that's got 1.30000 or 1.40000 or 1.50000 they love. You remember, some of you, quite a few years ago now, that the pound dollar got very close to the pound, $2 to the pound. It took a lot of money, if you like, a lot of effort to push it beyond that point, because most people thought it was a big psychological level. That's where it was going to stop. Now, if you know that it's likely to stop at 2, you do not start trading it up, do you? No, well, not unless you want to loan something to the market, and you can do that anytime. Most of us can do that without any problem at all. All right. So when you have lines on your charts, support and resistance lines, you take note of where they're going. Can you see that that was a support line, psychological line of 1.3. I couldn't get it bang on 1.3, but it's around that level there. That stopped there, went up, came back down, stopped down, came down. And what is actually happening is that the marketplace, the traders, the big traders, are waiting for these lines to be broken, because you get breakout traders. You've heard of breakout traders? Yeah. The breakout traders will be watching this line with great interest, particularly when it stumbles around the line, but eventually it closes. Now, the close is the most important thing, the most important part of a candle, the end of the day. The close, once the close occurs, that is now in tablets of stone. It cannot be changed at any time in the future. All right. So the fact that this red candle here closed there was significant, because up until that point, and I could probably take it back further, because certainly that wasn't the first touch at 1.3-ish. The significance of that is the fact that even on here, we're going from the beginning of February to the beginning of May, where that had held support. Once, twice, 3. And it's not just on consecutive days, it is months apart, which is even more significant. If it was just days, you know, Monday it sat there, Wednesday it sat there, Thursday it sat there, yeah, but those are all day traders today. These are people, the big institutional traders, who are looking for months and months and months. So there's a lot of money riding on the fact of when this is likely to break through that support line. Once it breaks through, then you have the option to consider a trade, and we'll talk about the trades later on. But can you see that support line now has been broken? Yeah? And that is significant. A spike through, like there, is not significant. All it is the big boys testing how much whether they can drag people into the market. And if they dragged enough people into the market, the chances are that would have gone back up to there. But they didn't. Right? There weren't enough people fooled. So here we have a close below. Now the next day, and what a support line, a spike below from a candle. That's a spike, yeah, because it then closes there. This is the support line. That is not significant. Yes, they tested the market. Yes, they pushed it through, but that does not mean that it's likely to go that way tomorrow. It's more likely to bounce off. If you then get a couple of days later one that actually closes below, and this is the close, and there wasn't much of a lower shadow, probably a little bit longer than that. That one closed there. That then has broken this support line. All right, that is now broken. If on the day here you are considering taking a trade, if the market, by the time you actually start looking at it at 7, 8 o'clock in the morning or 6 o'clock or whenever, bearing in mind the market opens the night before, if it's already been up there and touched that line is now resistance. Because the market is telling you it's gone up to there, stopped right on the line, pretty much there. See this one here? And by the end of the day, has come all the way back down here and closed again down here. If that happens in the morning where that has gone up to, particularly if this one has taken 3 months to break, there's a very good chance that the market is going to carry on down. Everybody see that? Right. So that is a support line becoming resistance, and obviously you would have a resistance line. Once you have a break or close above that line, and then the market goes up further, that resistance line has now become, particularly if it comes back down and touches the line, that line has now become support. So resistance can become support, support can become resistance. And that happens fairly regularly. To prove my point, that is the euro US dollar, and that resistance line there is running down here somewhere, isn't it? We're now into June. If we move forward, oh, surprise, surprise. The market went eventually down here, but it then started coming up. When it came up, where did it stop? It stopped at that former line that we've just, can you see that? Let me just zoom out so you can see the whole picture. And let me get rid of that psychological line for a moment, just so that it doesn't. You see that? Resistance, 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 came all the way down, came back up here. Where does it stop? It stops on this resistance line again. I haven't got it on this chart, but I can show you one that went on for nearly 5 years like that. And every time it got near to the line, it stopped. Then it came back down and sat on the line the following day. Can you see that line there? Let me just move it across now. Went up to the line and stopped. The next day it came back down and then closed up there. The next day it came down and sat on the line again as support before it moved off. When it eventually got up to here, and there's other reasons why that found resistance there, but we'll talk about that in a moment, then it started coming down, and when it came down, it's still using the same line. So that line is still current. You can see that, can't you? And that's going back to May. Now, there's only one reason that that keeps stopping on that line. It would be because nobody else has got it on their chart. So because it keeps touching the line, it's a good idea to have it on your chart, yeah? Because somebody else has noticed it. And rest assured, again, with the euro US dollar, when there's all this money coming down here and it stops on that line, it must be because some of the big institutional traders, the ones with very deep pockets, lots of brass, That's why it stops there. Okay. So there's lots of other support and resistance lines. That is just a flavour of what support and resistance means. But support and resistance is something that should not be ignored. Okay, candlestick analysis and patterns. I'll tell a very good story about candlesticks. Candlesticks were only brought into the UK or into the Western world in the late 1990s. Before then, all the big institutional traders had always used price bars, and many of them still do. However, candlesticks, because they were invented in the 1800s by a Chinese rice trader, and once they found their way into the Western world, they found wide acclaim because they are much easier to understand. And anybody new to Forex can understand those much easier than a price bar, rest assured. And so candlesticks have been around for quite some time. Janet and I met a guy on a plane a couple of years ago who is with a very large firm. I'm not going to say who it is, but he had got a dummies book to financial or technical analysis, a dummies book. I thought he was looking at an Excel book. When he actually opened it, he opened it to a page, and there aren't that many pages where there's illustrations in it. It's mainly text, but when he opened it, Janet said, he's got your candles. So I had a chat to this guy, and he just started looking at candlesticks because he'd been, or the guys in his office were starting to use them and were making quite a lot of money using these candlesticks. And he thought he ought to find out why they were doing so well and what it was all about. Now, this is only a few years ago, and this guy turned out to be the director of trading at one of the big companies in London. And he was responsible for trading, the trading floor. And he'd only just started to even think about looking at candlesticks. So that's why candlesticks are now regarded as being the way forward. But because they were invented by the Japanese many years ago, the patterns, which is what we're going to be looking at, there are thousands. The thing is that lots of them work in Japan, but they don't work for the rest of the big world. We're going to be looking at candlestick patterns that do work. How do I know they work? Is because you can backtest them. You can look at a candlestick pattern and you can look at it backwards through the charts, and you will see each time it comes up, it has got a very good chance of actually performing the way you expect it to. The reason for that is that there's probably a lot of people have got candlestick patterns on their charts, because otherwise it wouldn't work. Are you sort of getting the impression that what actually happens in the market isn't happening out in the cosmos somewhere? It is actually being affected by people. Yes, they've got big pockets or big amounts of money that they can use, and they can actually make the market move. We're probably going to have to, suffer that, because we're not going to make it move too much. Therefore, we will just do what they do. Okay, candlestick patterns. The first one I want you to show you here is this particular slide. Are dojis. Now, a doji is where you have a candlestick where the open has opened there, it's gone up to a high, down to a low, and before the close has pretty much finished in exactly the same place as where it started. Therefore, that is called a doji. Now, in itself, not particularly interesting, except for the fact that if you look what's happened before, and if there has been movement before and it hasn't been going sideways for quite some time, then if you've had, for instance, as in this case, you've had a green candle, yeah, and then the following day you get a doji, so it closes there, therefore the open on this candle is there, it goes up to a high, down to a low, and then before the end of the day it closes there. That is your doji after your move upwards or move downwards, it could be either. I want you to consider this in terms of, we were talking earlier about the bulls and the bears. The day before, this was a green candle, and therefore the bulls were in control on that day. It's going up. bulls are in control. By the end of the day, it closed there, so definitely the bulls are in control. The next day opened there, it went up to a high, down to a low, which I will put in. There's the high, there's the low, but before the end of the day it closed in exactly the same place. So when the market opened, it could have gone that way first or it could have gone that way, but during the course of the day the bulls have in fact pushed it all the way up there, and before the end of the day the bears have pushed it all the way back down again, and then before the close, the final of the day, the bulls have pushed it back up again to there. That is stalemate. Nobody's actually gained one way or another during the course of that day. All right, so that is what a doji does. Now a doji is basically indecision. That's what a doji is. It means that the bulls were in control. The following day it ended exactly where it started. Tomorrow could in fact go either way because nobody is sure, because there is this indecision. It could be that there have been a number of green candles and the market has gone up quite a long way. This could be just meaning, apart from indecision, it could be just that the market is taking a rest or taking a breather from going up and up and up and up. It might be that the high there has reached a resistance line, and if it has, then what has happened is it's reached that resistance line. Traders are concerned or not sure whether in fact it's going to get above that resistance line, and therefore they back off. When they back off, it comes back down to there. They didn't back off too much, but they backed off enough to give you indecision for tomorrow. Okay, everybody understand that? That's a doji, which in itself is fine because it warns you of a possible problem if you're in that long trade. However, the other two which are on the chart are more important, and those are the ones that I would like you to particularly take note of, and these are the gravestone, and the dragonfly. You will see them called other things in other textbooks. I don't care whether you call them Bill and Ben, as long as you know which one's which. All right? So these are the ones that I want you to take particular note of, because a gravestone doji is where the open is there. During the course of the day it goes up to a high there, which means the bulls have pushed it there. But before the end of the day, the close, the bears have pushed it all the way back down again. So pretty much equal distance, isn't it? But what is significant is if this gravestone doji follows a move upwards, because you've got the bulls in control, the bulls in control, the bulls in control, the bulls still in control, but before the close and the end of the day, the bears have taken over. They pushed it back down. In a large percentage of times, or in a large number of situations where this occurs, tomorrow we'll see the market go that way, because that's what happens. Right? With a dragonfly doji, which is the opposite to the gravestone doji, because the open and close are now at the top, I am now going to draw this one down here, open and close, because I want to show you that here the high is there, it opened there, the bears have pushed it all the way down to the low. Bears. But before the close, which again is the important part of the day, the bulls have pushed it all the way back up again. Pretty much even, except in the event that this follows a move where there are a succession of moves down, i.e. the bears are in control. Bears, bears, bears. The bears then carry on this day, but before the close, the bulls have pushed it all the way back up again. In a large percentage of times, the market will continue upwards the following day. Okay, so those are gravestone dojis and dragonfly dojis. And as you can see there, gravestone doji. Now, as you can see on this particular gravestone doji there, the open and close are not at the bottom. That is an ideal gravestone doji. This one is slightly higher than the low. There are qualifying levels, which I will tell you later, that if that open and close is within a certain percentage of the overall high to low, then it is still considered to be, or still likely that the following day it will go down. But I will qualify those to you later. I'm drawing on my finger. Okay, so that one is a gravestone doji, and here we have a dragonfly doji. Again, it has a body, a small body relative to the size of the overall dragonfly doji. From the high to the low, that is a significant move. That body, although bigger than perhaps we might like, is still pretty much insignificant. But as I say, there are qualifying levels, and we will talk about those later. Okay, so those are dojis, gravestone dojis and dragonfly dojis, and in a particular sequence of candles they are very, very powerful. Right, a flag pattern. This isn't necessarily the best example I could have found, but I did find it, and it still works anyway. What we're looking for as far as a flag pattern is concerned, I could find a lot of inverted flags. So whatever this is in terms of a flag that way up, also if a flag is down and that way, like a spade basically, it still works. All right? But they are continuation patterns. And what it actually means is that if from a particular low, you suddenly, over 1 or 2 days, get a very large move up, and I consider this move up to be from there because the market pushed it all the way down there, but then it came all the way back up again. So the move is from there to there. I think you'll agree that that looks like a flagpole. Yes? What you then get is a resistance area and a support area. And what tends to happen then is that you will get a number of candles which are sticking between the support line, we've done this before, haven't we, and this resistance line. Now, as I said, these are continuation patterns, and if the move up has been significant, which in this case it was, and then there's a consolidation period. Now, the longer this goes on, the better. The reason for that is that the longer it goes on, the more people that recognise it. And the more people that recognise it, the more likely the likelihood there is to it becoming self-fulfilling, like all the other things that we've looked at so far. So, if it goes on for a long, long time, my analogy to this would be like a plumber. And you've all done a bit of plumbing, I think, and got wet like I have. But if you're a plumber, if this is a concentration of water in a pipe, the longer it goes up, the more the pressure builds up, doesn't it? Yeah, over a distance. So if the market has risen from here and it's to the bottom of the support line, if that has gone up 150 pips, continuation pattern means that it must close above the resistance line. It must close out of the flag itself in an upward direction. i.e. continuing the move. Everybody see that? If it breaks out here, then that would be null and void, and the flag pattern has ended. All right? If it's spiked through, you might get away with it, because then the next day it might stay there and then go up to that one, and therefore you'd ignore the spike. But if it closes below that support line, the breakout traders are thinking they're going to trade this down. So there's more likelihood of it coming down, yeah? Because they've been waiting for this to break out of this support line. The flag pattern traders have been waiting for it to break out to the top. If that happens, they kick the cat, go poo, and go and do something else. However, if it breaks out there, the ruling on the flag pattern is that if there is 150 pips from where the rise started to the bottom of that support line, then once that closes there, you are very likely to get another 150 pips in that direction. That's useful to know, isn't it? Very useful to know. Because if that has been in a flag pattern for quite a few days or even weeks, the more people that have recognised it, the more that is likely to happen. You can sometimes measure this almost to the pip. So you know people are looking at it because it happens to the pip. I don't know what, I'll just show you the crosshair here, because there's the crosshair. If nobody knows how to measure from there to there, apart from looking here and subtracting it, which is long-winded, you go to the crosshair, which is the crosshair there. Everybody see that crosshair? Click on there and bring it down onto the screen, and you've got the horizontal and vertical axes. If you put the cross of that at the bottom of that candle there, yeah. If you then left click and drag it to where you want it to go, i.e. what we want to measure, I've taken it off now, what we want to measure is from the end of that shadow to the bottom of the support line there, and we'd like it to do it without moving. We go to the crosshair, we put the cross on the bottom there, and we drag it to the bottom of the support line. You will see that there are a number of figures following where you've dragged it to. The first one, which is 15 in this case, sorry, 5 it is, not 15. It's 5. It means that from where I've dragged it to where it is now, there, that actually is 6 movements, 6 days. Yeah, it's moved, I've moved it across 6 days. The cross is at the last figure is 80.666. If you were to extend where that cross is, that would actually come out over here at 8666. All right, there.